Cool. Thanks, Buddy. So I guess quick introduction into kind of my background. Um, I actually worked at Morgan Stanley for a year before, so I kind of got a bit of the finance and accounting training there before we started Seneca, which was kind of like B2C freemium education products. It's kind of a little bit like Duolingo, but focused on the UK. We grew that to, I think, 15 million total users, probably like 4 to 5 million monthly active users. That was mainly UK based. We did have some B2B partnerships in Brazil, B2G partnerships in Mexico, Brazil, different places, and then all across Europe. We worked on that. I think we did three fundraising rounds, but they were kind of very, very small because we were pretty inexperienced, didn't really have any credibility, and therefore it was super hard to kind of raise any money based on, I guess, that information when you're just starting out. We sold that company in 2022 to Go Student, then worked there for 2 years, and then started Novabook earlier this year. Um, it's quite interesting. It's very different, I guess, priorities when you're raising money. First time at Seneca and now it's kind of like a slightly different proposition. I'll go into that in a bit more detail later on. But more than happy to kind of share any feedback, thoughts, general guidance on that kind of stuff. I'd say, I don't know, should I dive into any particular like high level financial guidance per DM, or are there any questions that you want me
Yeah,
to go over?
I've got a few questions, but the main thing that we want to know is how you prepared the financial section of the whole pitch or the whole proposition when you were pitching investors, and how much that was scrutinized by investors, kind of the ambition of what your numbers were, and whether they thought those numbers were too high or totally realistic or too low, and any detail on that would be useful across the different raises.
Yeah, so I'd say, well, I had done financial modeling before, like partially as work. So I did have a good idea of how to build them, but I'd say I don't think there is much value in building a super complex financial model. I would say, how do I manage the business and how do we raise? The model can be like 10 to 30 lines long. I generally think if you're building like a 100 line financial model, that's probably very useful at a stage of maturity the business is at, but I don't think it's strictly necessary too early. So I'd say a simple model is good enough. I think there are, if you were like taking the 80/20 approach to kind of what matters here, I'd say there's two things that matter that give most of the benefit. One is your total addressable market. Like most pitch decks will have a slide showing what your total addressable market is. Um, it's so easy to go wrong here because you kind of want to show a massive number. So I just Googled like accounting industry size and Google's like snippets here. Say it's 636 billion growing 5% a year to 2032. And I think most slide decks basically just go 636 billion is our market. And that, I think I did that with Seneca maybe. It's like the global education market is 1 trillion, but realistically, you have like that includes school buildings, school teachers, international and private school fees. And it's like we basically have no intention to do any of those things. So I'd say you feel like you should do that, but I think it shows some misunderstanding or lower credibility relative to a more well-reasoned number. But I did that just because you're like, this number needs to be big. I think that matters more for your business, where if you think it's really easy to get revenue in your market, a big number makes you not scrutinize if your business is big enough. Like loads of you will talk to venture funds, and therefore, if you're like, oh, my market's 1 trillion, happy days, realistically, you can be in a market where actually people will pay you 2 million in revenue. You raise from a VC fund, and then there is just structural misalignment in how big your business can be. So I'd say that for investors, you need a TAM model that is sensible. Like with Seneca, I didn't do this. This was just because I didn't know really what to do. With Novabook, you have a top-down number, which is like, what's the most verifiable number I can find in a third-party study? Then we built a bottom up, which is like, how many customers do I actually need to pay me this amount to actually make the TAM number good? And they should reconcile. Like if you're sitting there thinking, I'm building something in the UK and there's 50,000 customers, realistically, if you're ending up at a TAM of 1 trillion, something's gone wrong somewhere. So I would say you can obviously argue over time you could expand to every person in the world, but I would say have a bottom up model, which is just number of people paying you X price, maybe gross margin, maybe operating margin is a rough kind of rule of thumb. But I'd say build bottom up as well as top down. But I'd say it's more for you than investors because if you start a business where your TAM is £1 million, you'll probably win 20% of it in 5 to 10 years. And then suddenly, is it enough to sustain the team and what you would like to build would be the kind of first point.
Yeah.
Then I'm sure this will come up later, but I'd say I see lots of financial models where stuff gets really good in year 6, 7, and 8. And I'd say really good to like the 8 to 10x revenue every year from there. And I'd say like credible VCs who fund the best companies in the world would expect you to start out and then 3x revenue, 3x revenue, 2x revenue, 2x revenue, etc. So I would say if your revenue is going like, I don't know, there's a lot of models that are like 50%, 60%, 70%, 500%, 700%, and your revenue goes from like 2 million in 3 years' time to 24 million the year after. That might be possible. Like, it depends on your context. Like, all investment advice is context dependent, but that's not a common pattern. And if it's not a common pattern, it probably is not going to happen. Like you'll see some companies that do it. Like, I don't know, if you look at Hopin in COVID, I think it was way more extreme than that. But I don't think you can plan on like pandemic levels of behavioral change normally.
Mm.
So if you assume like a bullish, super bullish case would be we're gonna execute everything perfectly, you might be able to treble your revenue every year. And then that obviously gets harder the bigger the number you're trebling is. But that would be my rule of thumb. And
Yeah.
often you see 3x, 3x, 5x, 10x, and that's possible, but people will probably, it just looks a bit silly because when you actually scrutinize it, the operations to achieve that are so unbelievably painful that it probably wouldn't work. So those are the two things. I'd say TAM, you want top down to look big, but I would go bottom up. And then uh trebling is the max that's credible that I think anyone will think is believable.
Yeah. I think one thing that founders often struggle with is because they're still playing around with the pricing model, having some of those kind of key model drivers, the things that are gonna get you to that number that you need in order to reach your TAM. It's still like a bit of guesswork at the moment. So of those key drivers, which would be how much you're charging, how many customers you're going to have, what your growth rate is going to be, is there anything else that would stand out to you as an investor, or that you did when you were raising for Seneca that you think it's important to have some fundamental assumptions about before you even start?
Yeah, so what are the most important inputs? It's a good question. So Seneca is kind of freemium, so you basically have to get like millions of users for even breaking even. So that would have been like we need this many people using it this frequently, and this percentage need to pay to cover the cost for everyone else to use it for free. It is business specific, but I would say most stuff is simple and don't overcomplicate it. It's like how many people are going to pay you and how much are they going to pay. The benchmark for how much are they going to pay is how much would they pay someone who is very similar as a provider to do it at the moment. I would say if your software benchmark against software, a lot of people say, oh, we're going to automate two of your headcount, therefore your willingness to pay is two salaries at £40,000 a year, therefore people are going to pay £80,000 a year. I think that gets pitched by every enterprise SaaS company ever, but they sell software. So you are selling software that is benchmarked against software. So it's really complex software. Your pricing is going to be 1,000, 2,000, not 80,000, because those people aren't actually going to be replaced. They're going to use your tool and it might save them time, but it's not going to do that. And yeah, price times quantity. It's a good equation. It's just, it is that simple. It's like, are people paying you more and how many people are paying you more? And then that is basically how I'd construct the model. But there obviously be exceptions if you're like freemium or different kind of business model structures.
Yeah, and then if you've got this kind of leap that you were talking about earlier, um, and it's higher than you're saying, so it's higher than that 3x, 3x, 2x thing. Um, I'm guessing you need an input for like a huge marketing spend or a new country launch, or like there's something big that's happening that relates to that number. So how much would you, if you saw a number jump up like that, would you be like, oh, okay, actually that makes sense because I can see in your costs that you're doing something, there's big marketing spend, or there's something that relates back to it, versus you'd be like, it's
If
too unrealistic.
if I'm completely transparent, I don't think anything spending more doesn't lead to more revenue in most cases, and the connection is too loose. When I see a chart that goes like that, I just flatten it psychologically and it just becomes a straight line that grows at a normal rate. I'd say having seen international expansions and seeing product launches and stuff, the probability you spend way more and it goes 5x is so low. It might be a very slow burn and it ends up being another 3 3 2 2 in terms of the triple, triple, double, double, double. But it's like that's most likely if you launch something new. And it's probable that your existing operations will grow slower if you do that because it's a massive distraction, an
Mm.
operational challenge. So I'd basically say if you have like an exponential hockey stick curve, it might be possible. And if you can do it, you should do it. I'm not saying don't try for it. It's just the reality of operations are basically very painful. So therefore, 3x is like almost the max that's feasible, I would say, except in like an extreme outlier scenario.
Yeah. When you were fundraising with Seneca, at what point did the forecasts come up in the conversations? Would it be after an initial pitch when you've got someone that's interested? And did anyone like literally not care? And then you had other people that really were scrutinizing it a lot?
Um, yeah, with Seneca, the model, I think a lot of the job of a model is to show thought and detail orientation.
Mm,
If you have incredible assumptions, it makes you incredible to a degree. Therefore, it's kind of like, has this been considered? How are you spending money? And is this sensible and also big enough? Seneca business-wise and TAM-wise, probably, I mean, it wasn't venture scale just because the market wasn't large enough. And that's kind of, I don't know, with 4 million people using it a month or whatever it is now. So I would say that is like a real adjustment, but it depends on market. Um, some people scrutinize the model a lot. I don't think it just varies person to person. Like I don't look at models just because it's more like, is the market big enough and can the people execute is more important than the details of are you going to grow 60%, 80%, whatever. Like I think most of the problems are like personnel and market size and they are exogenous. But like if you saw a model that made no sense, it would really not be a good sign. And so if you have the right team, right, whatever, a ludicrous model doesn't help that much. You kind of need to adjust it for like, I would say a model that shows an enormous hockey stick suggests operationally you don't know how to scale. I'd say you need some credibility where it's like, oh, we're just going to 10x revenue and our costs aren't going to go up and it's going to be great. It's like you worry operationally about the company, not
mm,
because it's just like that just doesn't happen realistically. Like you having like done 10 years of grinding, it's really hard to 30% grow off like a couple of million in revenue, let alone 10x grow on 5 million of revenue and suddenly you're at 50. Like I'd say it's more like an operational red flag than
yeah,
anything else, just because that is tough.
yeah. So I guess as a second time founder, you have the experience of going through it the first time. So you'll say we know that we worked really hard and we did everything we possibly could and we still only got to like 2x, 3x at the end of the year. So then we know that doing a financial forecast for the second time, if we suddenly put like 50x or something, that it would seem naive or people would think that it's unachievable. But as a first time founder, you just might not know that because you haven't actually had the experience of trying to do what you're putting in the model.
Yeah, I'd say that I think that's fair. Like we're probably trying to 3x at the moment. I can say it's not painless. Like it's pretty tough, and even then, hitting it's difficult.
Yeah. Yeah, that makes sense. Did you have any with the numbers, did that tie into how comfortable people were with your valuation, especially when you're talking about the TAM, but as well with like how quickly you're growing? Did that affect valuation conversations?
Um, it's an input, but I would say I think the main thing when you're thinking about valuation is like a lot of founders can develop an us versus them mentality, where it's kind of like our job is to get the maximum valuation and their job is like that's for them to worry about. I don't think that's helpful at all because you need investors and also there is kind of just like a responsibility to try and do your best for them as well. I'd say what you need to think of is if someone's investing in your company at a valuation of 10 million, you have to think there's a really good chance you can get to 100 million. Because if you turn around and say, I think it might be a 15 million, they're basically putting money in your company. They probably won't see it for 5 to 10 years. And if you think that's likely, they probably wouldn't invest. So I would say you have to raise at a valuation where you think there is a really credible possibility you can build, I don't know, 5, 10, 20, 50x, depending on what business you're building and the type of investors. But it's more like, are you comfortable that you can do that? And if you're not, your valuation should probably be lower.
Yeah.
Like a lot of things are just like, oh, you just sell 15% of the companies. Like you shouldn't do that if you actually think the upside is 10% for the investor in 5 to 10 years' time. There's obviously like worlds where in 50% of cases it's 100x and in 50% of cases it's worth nothing. That's like a risk investors understand. I'd say in like what you believe the most likely or the best case, that's where you need to make the adjustment, I'd say.
There's I'm gonna move to questions shortly. So if you're here and you've got a question for Stephen, please raise your hand. There was someone that DM'd me a question on WhatsApp because they can't make it in person, which was about the level of granularity that you would go into about forecasting anything to do with global expansion and the cost base for global expansion when you're raising a seed round. So I don't know a huge amount about their business, but I'm guessing they're only UK based at the moment, raised pre-seed, but are looking to grow in the future. So that might come into the 3 to 5 year projection.
Um, I'm not sure, to be honest. I'd show enough work that you've considered it and that it's a credible org structure to expand into a new country. But um, I wouldn't go into insane detail. Like I'd say breaking down the personnel you need and the costs high level that function, like the three main costs that you have operating in the UK plus the headcount of who you will hire, I think is sufficient because there's also like if it's in 3 years' time, you don't want to spend too much time on forecasting stuff like that. The main thing on international expansion would be like, I would say if you're not doing it personally and moving to the country, I think it's too difficult to even consider. Like we've tried loads of countries with loads of different stuff, with loads of different structures, and lots of friends have. I'd basically say you have to go there, which
Yeah.
would be the main input of like, are you actually willing to move there? It's not a financial model input, but it's like, are you going to go and live in the country and run everything there?
Yeah.
And if not, is it worth doing rather than how much does it cost?
Yeah, that makes sense. Another quick question from me. Based on your experience, either fundraising or investing, and I know you say you don't look into the model too much, but a lot of people, when they're fundraising, they're raising for like 18 or 24 months runway, but then their financial model will be 3 years or 5 years. So they're projecting what happens after they might be raising again for a second time. And that next future raise is based on the success of the prior raise. So it's almost like trying to plan in the future and you're trying to plan to hit certain milestones to then raise again. And that all gets put into one sheet. If you're an investor coming in on that first raise, are you more interested in what's happening in that first 18 months to 2 years or the long-term vision, which also will mean potentially another fundraise in the future of an unknown amount?
So I'd say potentially you should also ask a VC this because I have a different mentality, but it's more like what matters is the credible path of revenue. It's not like, am I looking at year 10? Am I looking at year one? It's basically like, does year one lead to year 10 in a credible way? And is year 10 good enough that this can be a good or large company? That's the arc there. Yeah, venture investors, by nature of what they do, rely a lot more on your next round. Like they need you to raise again so that they can show that they've invested well, so that they can mark up the portfolio and show they've invested in the right stuff. So they would worry more about, I guess, will you raise money again? What milestones do you have to hit? I'd say if you're sharing forecasts, you've got to try your best to hit them in all cases, just because that's like a responsibility on you. For me, I'm more operational personally. I like operating, and therefore I'm probably more just like bottom up, is this a good business? And then I just assume if it is a good business, someone else will cover the large majority of the next round. But VCs might have a different take on that.
Yeah, yeah, that makes sense. And just last quick one, just because you mentioned 10 years, how long, how long into the future did your forecast go? And how long do you think it would be realistic for someone to prepare at this point?
Um, I think 5 to 10 years is reasonable. I guess a lot of company value, especially in early stages, is in the terminal value. So, like at the end of the model, what is your revenue? What is your revenue growth rate? What is your gross margin? What's your operating margin? Therefore, if it's that kind of business, which I assume most are, you should go out that distance. But essentially, like models at that point, like if you look at how like banks would look at public companies, it's basically your gross margin is going to be 12%. Your gross your cost of goods sold will be 12% of revenue at this level of maturity. Like as businesses grow, you basically end up modeling stuff more on instead of bottom up of like I'm going to hire 4 engineers at this salary and a salesperson. It generally becomes the business structure is your revenue is X, your cost of goods sold is 0.2x, therefore your gross margin is 80%. Your sales cost is 20% of sales, your marketing cost is 10% of sales, your, I don't know, SG, no, like your general costs are 10% of sales, and then your operating margin is 40%. Like over time, things grow large enough that you just end up at those kind of convergences. And I think the main question investors look at is what is your business converging on in 5 years, 10 years, rather than how many engineers are you hiring now? Obviously, you have to try and solve the two things in the same model, but those are kind of how things are looked at a higher level of maturity. At least that's how I would do it.
Yeah, that makes sense. Thank you so much. That's really useful. For the cohort members, does anyone have any specific questions on this topic? So on financing, funding, numbers side of things, feel free to raise your hand and put it in the chat in the next kind of couple of seconds. If not, I'm just going to let Engen in, who's the next speaker. Oh yeah, Ben, you just raised your hand.
Stephen, it was really interesting to hear that when you look at the hockey stick, it just loses all credibility because you go, well, actually, you don't know what you're doing with scaling a business. But I guess how do you balance that as a founder? You want to show great potential, you want to show that there is growth opportunities, but you understand that actually it's not as simple as we're just going to plug these numbers into a spreadsheet and everything's going to go to plan. Is that I guess is that through lowering the projections? Is that through voiceover? Is that through the way that you present the information? What are the things that you can do to really demonstrate that greater awareness?
So I guess you have different growth arcs. I'd say the average for most businesses is you see a single model for a single business in a single place and it has a hockey stick. That should be you temper the growth gradient lower rather than assuming a 5x in a year that continues when it's way harder to 5x revenue because you're going from a larger base. If you're saying international is going to be amazing in year 4, you can assume potentially a step change in revenue. but you probably will have a hugely inefficient step changing cost where you probably waste 40 to 50% of it. So if you're saying revenue is going to go up in this year because of an international expansion, you have to credibly take the economics you see in the UK business if you're starting in the UK the year before, take the same dynamics, and then transplant them to the international market and assumptions where your cost efficiency is going to be way lower because it's going to be way harder. So basically, if you were like, revenue is 4, we think revenue can go to 12 if we spend internationally, but you're generating the 4 million in revenue on 2 in cost, let's say, your cost to go and do that is probably going to be 6 to 8, and then you'll probably have a huge cash burn. That's actually credible in terms of how you can go and acquire that revenue internationally. Like, it's very rare you expand internationally and it's better than the place that you have a brand, have started everything before, know the intricacies, started the business there, and it gets better internationally. Like that can happen over time, but I don't think you can assume that.
Okay. Thanks. So it's demonstrating that you know that as the complexity increases, actually it's going to disproportionately impact the margins.
Yeah, I'd say that's what I see in most things that have done that.
So, thank you.
Nice. Any other questions? If not, we're going to move to some live pitch feedback. So if you do have a question, feel free to pop it in the chat. That might be easiest to manage. If you would like to get some live pitch feedback, we will ask that you share a deck. Actually, before I go into this, I'm just going to start recording.